How do you differentiate taxing for dividends and capital gains? Overview. Investors can earn income through dividends or capital gains, both subject to taxation but in different ways. Dividends are typically payments made by companies to shareholders, while capital gains represent profits from the sale of assets. Please find out more about our Board of Financial Review. Endowing in parities, mutual funds, or conversation-traded funds allows you to receive dividends. Your tax return, Form 1040, with Schedule B should contain them. When the value of an asset rises between the time of acquisition and the time of sale, capital gains occur. Whether a dividend is qualified or non-qualified determines the tax rate. Qualified dividends are taxed at 0%, 15%, or 20%, while non-qualified dividends are taxed at regular income tax levels. Assets held for over a year are subject to the capital gains tax rate of either 0%, 15%, or 20%. In contrast, assets held for less than a year are subject to ordinary income tax brackets. The capital gains tax rate is contingent on when the item was carried. Point 1. Taxation of dividends. Dividends can be categorized into two types, qualified and non-qualified. Qualified dividends. These are dividends from U.S. corporations or eligible foreign companies, provided the funder holds the stock for at least 61 days during the 121 days surrounding the ex-dividend date. Depending on the investor's income and filing status, they are taxed at preferential rates of 0%, 15%, or 20%. Ordinary, non-qualified dividends. These dividends do not meet the holding period requirement or come from certain types of companies. They are taxed at the investor's ordinary revenue tax rates, which fall from 10% to 37% based on income. Taxation of capital gains. Capital gains taxes depend on how long the investor holds the asset before selling. Short-term capital gains, profits from possessions held for one time or less, are taxed at ordinary income rates. Long-term capital gains, profits from assets held for more than 1 year, are taxed at the shorter capital gains rates of 0%, 15%, or 20%, depending on income and filing status. Capital gains tax brackets, 2024 to 2025. Filing status 0% rate, maximum 15% rate, maximum 20% rate above. Single $47,025, 2024, $518,900, 2024, above $518,900. Married filing jointly $94,050, 2024, $583,750, 2024, above $583,750. Head of household $63,000, 2024, $551,350, 2024, above $551,350. Offsetting capital gains. Capital failures can be used to offset capital gains. Short-term losses can only offset short-term gains, while long-term losses offset long-term gains. If total losses exceed gains, up to $3,000 of the more loss can be deducted against other income. How taxes apply to dividends. Regular income tax rates affect average dividends. A capital gains tax rate is applied to qualified dividends. The rate applied depends on a person's filing status and whether their income is under or above the maximum amounts for the rate. What is the difference between capital gains tax rates and ordinary tax rates? They are lower. For instance, if your income for the tax year 2024 is at or below $47,025 as a single filer, your capital gain will not be subject to taxation. The tax rate is 15% if it is above that threshold, but at or below $518,900. Any amount over that is subject to 20% tax. If I have qualified dividends, where would I see them? The financial institution or business that paid the dividends should provide you with Box 1B of Form 1099 DIV, which lists qualified dividends. Conclusion. Comprehending how capital gains and dividends are taxed is vital for administering investment income efficiently. While ordinary dividends and short-term capital gains are taxed at higher ordinary income rates, competent dividends and long-term capital gains reward from lower tax rates. Proper tax planning can help investors minimize their overall tax burden.